In this video, I'm going to share with you how you can build yourself some passive income through dividend investing. That means putting your money to work for you and earning you income while you sleep, go to school, go to work, or sitting there watching this YouTube video. Now, I'm not trying to sell you anything here, and this is definitely not something just for the rich and definitely not some type of pyramid scheme. You can start doing this with as little as $20, $30, or like $50. Hey guys, welcome back to the channel. If you're new here, my name is Kevin, and on this channel, we talk about strategies to help you along on your financial journey. If you're interested in investing, personal finance, no matter how new you are, consider subscribing to the channel to follow along and liking this video to help the YouTube algorithm push this out and help more people. So if you watch to the end, you're gonna know what is a dividend and how it pays you, how to buy a dividend stock, mistakes to avoid, and in the end, we're gonna go over how much you need invested to live purely off of your dividends. So in order to know how to dividend invest, you're gonna need to know what is a dividend. You can think of a dividend as a thank you or a bonus you get just for holding the company stock. Because holding a share of the stock means that you're a very, very small fraction owner of the company, it's like sharing the company's profits with you. You get paid this amount about once every quarter, so 4 times a year, although there are some special cases that the company would maybe pay you once every year instead. Taking a look at an example, here is AT&T, where each share is trading at $28.93. And if you look down here, you'll see that the dividend payout is $2.08. The number beside that is the dividend yield. If you take $2.08 divided by $28.93, you get approximately 7.19%. This is just another way of representing how much money you're getting back for holding the stock, in this case about 7% return on your money. And you can use this number to compare with other dividend paying stocks as well, but this isn't the only number you want to look at, but we'll go into more details for that later. So another way to think about this is like buying a house and renting it out. You buy the house is like buying your stock, and you get money for renting it out, just like how you collect dividends from the stock. You've probably come across a lot of these dividend paying companies without even knowing it. If you have an iPhone, Apple pays a dividend. Have you been to Disneyland? Disney pays a dividend. Been to a Costco? Yep, they pay a dividend. These are usually not your hyper high growing stocks like Tesla or GameStop, and more so your steady growth profitable companies that instead of reinvesting all their money back into the business, they share some of their profits with their shareholders. Now, that's not to say that dividend companies don't grow. If you take Apple, for example, in the past 5 years, they've gone up a ton. It's best to find companies that are both growing and strong fundamentally, but also pay some dividends so you can get best of both worlds, the income from the dividend as well as the appreciation of the stock. Now, why would you want to buy some dividend stocks? There's a saying that goes something like, you're either investing your time to make money, which is working a regular job, or you're investing your money to make even more money. That's more like what dividend investing is like. You're buying these dividend stocks that then pay you a dividend, generating you passive income without putting in extra work. Dividend income is also a bit more stable because the dividend that gets paid out from holding the stock doesn't change day to day like the stock price could. Although, yes, there's stability here, you want to be careful not to put all your eggs in one basket, because if a year like 2020 comes around again, companies may have to cut their dividend just to stay afloat. This is why you need to look at the fundamentals of the company, looking at how long they've been paying out dividends without cutting, do they regularly raise their dividends, but more on that later. Especially if you start early and you reinvest the dividends you get into buying more of these stocks, through compound interest, your portfolio can grow and snowball really quickly. If you want to know about compound interest and compound gains, I talk more about that in one of my previous videos that I'm going to link somewhere up there. And lastly, buying dividend stocks is just a good way to diversify. Not only are you diversifying different types of stocks and different sectors, you're diversifying the types of income you're getting. There's stock appreciation, which could be separate than your dividend payouts. Now, buying dividend stocks is no different than buying any other stock. You can use apps like Robinhood, Webull, M1 Finance, brokerages like Fidelity, or any others you may use. If you want to know how to buy a stock, check out my video on how to invest for beginners that I'll link somewhere up here. But before you go out there and buy the highest paying dividend stock, watch through the rest of this video because we're going to go over some costly mistakes that you're going to want to avoid. Now, first off, like I said, don't put all your eggs in one basket. Companies can and will cut dividend if they need to do that to stay afloat. This is why you need to look at a company's history and fundamentals, like how long they've been paying out dividends, have they been increasing dividends over the years. Take Coca-Cola, for example. They've been paying out dividends since the 1980s and have been steadily increasing the amount year over year. Doing this type of research will help you avoid any dividend traps. Dividend traps are stocks that have a really high paying dividend to attract investors like you and I, but they may have a lot of debt, aren't profitable, and aren't able to keep up with this payout. That means they can cut their dividend at any time, or worse, their stock could be a sinking ship that goes down more than you get in dividend. For example, if you have a stock that pays 5% dividend but goes down 10% in a year, you're actually down 5% there. This is why you want to look for good quality companies, looking at their fundamentals, dividend history, how much they've paid out over the years, if their dividend has been going up over the years. Worst is if you're relying on that dividend payout for income and you need that money, but the company decides to cut their dividend. If you look at SITC, for example, in the 08-09 crisis, they cut their dividend hard. Compared to Coca-Cola, which we looked at earlier, they had steady increase of dividend even across this time period. For those of you that don't want to go through the hours of work needed to research the fundamentals of what a good and a bad company are like, you can buy dividend-based index funds or ETFs. For example, Vanguard has an ETF called VIG, and this is an ETF that contains about 200 or so dividend-paying stocks with an average yield of about 1.6%. That means just for holding this stock, you're going to get paid out 1.6% every single year. Some of these index funds and ETFs even offer something called a DRIP, a dividend reinvestment plan. This means that instead of paying you out the dividends, they'll automatically reinvest this into more of that dividend stock. That means you can really turn this into a hands-off experience. Now, a quick bit about taxes. A lot of these dividends fall under what's called qualified dividends. That means that the dividend payouts you get from these companies are subject to only long-term capital gains tax. So that's about 15-20% instead of short-term gains, which is essentially your income tax that can range from 30-40% or up. Better yet, you can buy these stocks through tax-free accounts like the Roth IRA and pay zero tax on the gains. But more on that in a different video. For those of you who watched till this point of the video, I really appreciate you following along, and it would mean a lot if you could help hit that like button to share the knowledge in this video with more people. Now with that said, let's go over how much you need invested to live purely off of your dividends. So looking at one study, the average living wage in the US is about $69,000. And then the average dividend yield in the S&P 500 is about 4.31%. Calculating that out, that means you'll need about $1.6 million invested to live purely off of your dividends. Now that might seem like a lot, but if you start early and stay consistent through compound growth, this is an amount that's very doable. Now, your lifestyle, the dividends, the stock prices, or the economy can and will change. This could be for the better or the worse, but hopefully this gives you a broader perspective on different ways you can diversify, not only through buying different types of stocks, but also different ways of diversifying your income streams. Dividend investing is a way that you can put your money to work for you, generating you passive income as another stream of income. Remember to do your research before you buy into stocks and avoid any dividend traps. Again, if you start early, stay consistent and reinvest your gains, even if you're not buying dividend stocks as they're just one tool in your arsenal, if you do this, you can and will one day build a portfolio that could support part, if not all, of your needs. Hey, welcome to the end of the video and thanks for watching. I really appreciate it if you watched till now, and I really hope you learned something from the video. If you want to see more videos like this, subscribe to my channel, like this video, and comment down below what you want to see me talk about next. See you in the next one.